Every trader has felt it. That sinking feeling when markets start dropping. The stomach-twisting tension as your portfolio loses value by the second. Fear, more than logic, more than numbers, often drives every move in the stock market. But why? How can something as intangible as emotion control the flow of billions of dollars and shape global economies? Today, we're diving deep into the psychology of fear, how it manipulates investors, and why understanding it could be the key to surviving and thriving in markets that often feel like chaos. By the end of this video, you'll see the stock market not just as a collection of companies and numbers, but as a living, breathing reflection of human emotion. Fear in the markets isn't just a metaphor, it's a measurable force. Neuroscience shows that humans are wired to respond more strongly to loss than gain. This is called loss aversion. Losing $100 feels twice as painful as gaining $100 feels good. Combine this with uncertainty, and fear becomes contagious. Traders react emotionally, sometimes ignoring facts, valuations, or trends. This is why rumors, news headlines, and even social media posts can trigger massive market swings. Psychologists also call this herd behavior. We mimic others in uncertainty, creating feedback loops of panic. When one investor sells, others follow, even if fundamentals are solid. Historical example, the Panic of 1907. A single bank's collapse spiraled into nationwide fear. People withdrew deposits en masse. Stocks tumbled, not because of business failure, but because fear spread faster than facts. Markets are human, and humans are predictably fearful. Let's take a journey through history. 1. The Great Depression, 1929. Overconfidence in the Roaring Twenties met with sudden panic. Margin trading amplified losses. When the market dipped, fear turned a minor correction into catastrophic collapse. 2. Black Monday, 1987. The Dow dropped 22% in a single day. Algorithmic trading and panic selling collided, creating a chain reaction. Investors watched the market fall and sold out of fear, not logic. 3. Dot-com bubble, 2000. Hype and fear danced together. Investors bought everything tech-related. When the bubble burst, fear amplified losses, forcing many to sell at rock-bottom prices. 4. 2008 financial crisis. Subprime mortgage defaults triggered a domino effect. Panic spread globally. Fear dictated policy and trading. Central banks intervened to calm the irrational waves. In each case, rationality was secondary. Emotion ruled. Understanding these patterns is crucial. Fear is not an anomaly, it's the engine behind every market crash. Today, fear spreads faster than ever. Social media and 24-hour news amplify every headline. A tweet can tank a stock before fundamentals matter. Algorithmic trading. Many trades are now automated. Fear triggers algorithms to sell in milliseconds, magnifying swings. FOMO versus fear. Fear isn't just about losses, it's also about missing out. Fear of missing a rally can drive irrational buying, inflating bubbles. Retail investor panic. Platforms like Robinhood connect millions to the market instantly. When fear hits, it spreads virally. Meme stock rallies in 2021 weren't purely about fundamentals, they were fueled by collective emotion and fear of being left out. Global events, wars, pandemics, elections, all inject uncertainty. Fear becomes a global contagion affecting every market. How can investors quantify fear? Meet the VIX, also called the Fear Index. It measures expected volatility in the S&P 500. When the VIX spikes, markets are nervous. Other tools, put/call ratios. High ratios indicate investors are buying protection against losses. Margin debt trends. Excessive borrowing can amplify fear-driven selling. Market breadth. If few stocks lead gains or losses, fear may be concentrated and contagious. Recognizing these signals doesn't make fear disappear, but it helps investors prepare, allocate risk, and avoid panic-driven mistakes. While fear will always exist, disciplined strategies can reduce its power. 1. Diversification. Don't put all your eggs in one basket. Spread risk across sectors and asset classes. 2. Long-term perspective. Fear thrives in short-term thinking. Historical data shows markets recover over time. 3. Risk management. Stop-loss orders, hedging, and position sizing help protect portfolios. 4. Education. Understanding market psychology reduces impulsive decisions. Fear loses power when knowledge dominates emotion. 5. Mindfulness and discipline. Sometimes, the best trade is no trade. Recognize emotional triggers before reacting. Fear is the invisible hand guiding markets. It can topple empires, bankrupt businesses, and reshape the global economy. But it can also create opportunities, for those who understand it. By recognizing fear, quantifying it, and controlling our responses, we turn an unpredictable force into a manageable one. Remember, the market isn't just numbers and graphs. It's a reflection of human emotion, and nothing is more powerful than understanding the psychology behind it. If you found this analysis enlightening, subscribe for more deep dives into the forces that shape our financial world. Knowledge isn't just power, it's protection.